Hi everyone, my name is Ryan Jones and I want to welcome you to my second video blog. It's entitled Warning: Why You Shouldn't Trade Credit Spreads and the Secret to an Unbelievable Winning Percentage. I think you're going to enjoy today's blog. You're going to find out stuff that you will not hear anywhere else. No one else will show you what I'm going to show you today. And it's some really good stuff. But before I get there, I did have some questions after my last video blog about the various products and websites that are associated with me. So I wanted to just really quickly give you that information and then we'll get into the meat of the blog. First of all, the parent company is Quantum Trading Technology. So all of these various products that I have created over the years are all fall under the umbrella of Quantum Trading Technology. So we have PaydayStocks.com. That, of course, deals with weekly options, and the projection graphs that you'll see in today's blog is from PaydayStocks.com using PDS Trader. Then I have SeasonedStocks.com, and that focuses on seasonal opportunities in stocks, which I think will be quite shocking and surprising to some of you just how many seasonal opportunities there are. You can take a look at that. And then there's fixedratio.com. And fixed ratio is a very specific trade size money management approach that I developed many years ago. And so that's at fixedratio.com. And then there's tradepartner.io, which is a trading platform that we have been developing, which is going to change the way that you trade. That is not yet out to the public, but you will be hearing more and more about it over the coming months. All right, so let's get into today's blog: why you shouldn't trade credit spreads. I'm going to do the first part first, and then I'll get to the incredible winning percentage part of it at the end of the blog. So, why you shouldn't trade credit spreads? Well, let's first talk about a credit spread. Just make sure we're on the same page. A credit spread is simply where you sell one expiration strike call, and then you also, at the same time as a spread, buy the same expiration but a higher strike call. And because the higher strike call is going to cost less than the lower strike call, you are going to create a credit when you place on this trade. So that is a credit spread. You can also put on a credit spread with puts, and you just simply sell one expiration strike put, and then you buy the same expiration lower strike put. That makes the price of that put cheaper than the one that you sell. And so again, that creates a credit between the two puts. So either way, you can create a credit spread with calls and puts, and that is the general terminology that is associated with a credit spread. So let's take a look at an example, and I'll use this one to demonstrate why you should not trade credit spreads as a general rule. So here's an actual example. It's selling one SPY April 6 269 call at 74 cents and buying one SPY April 6 270 call at 54 cents. Now, at the time of this blog, SPY is trading at about 263. So this is an out of the money credit spread. And the strike difference is 1 point, and then we were able to create a credit of 20. So here is the projection graph of this very particular credit spread, and they're very similar. So this is a very good representative of a typical credit spread. And of course, the industry is infatuated with credit spreads, but I want to analyze this just a little bit first to kind of break it down. The first thing you need to understand is that the profitability, or the profit probability, I should say, is sitting at around 79-80%. And that's based on current volatility in the market. And what has to happen for this particular trade to lose money is that the market has to go up all the way past 269.20. So at 269.20 or above, it begins to lose money. And that loss is capped at 270 or above. And then if the market is below 269.20, then you will make money at the time that this trade expires, period. It can go to zero and you will make money. So you have a small profit potential and a little bit larger risk. And so let's break that down a little bit. And the market, by the way, is where this line is. So right under 264, showing at about 263. So the market has to go up quite a bit, and this is March 30th, and this is the first day of a 3-day weekend. So by the time we get to the next trading day, it'll be April the 2nd. And so the market does have to go up quite a bit in 4 trading days for this trade to lose. But again, the market has been volatile recently, so that's why you're able to get a 20-cent spread, or excuse me, credit on a credit spread that is so far away from the market. All right, so let's take a look at the probabilities of this particular trade. And the risk on a credit spread is always the strike distance minus the credit. The strike distance minus the credit. So the strike distance is 1, right? 270 minus 269, that's 1. And you subtract the credit, that's 20 cents. And you come up with 80 cents. That is your risk on this trade, and that's how you figure out the risk on any credit spread. And then, of course, the profit is basically the credit. And in this case, it's 20 cents. So with that, you have an $80 risk and a $20 profit potential with a 79% probability of profit. So just looking at this, would you say that this is a positive mathematical expectation or positive mathematical expectancy? No, it does not. It is not a positive mathematical expectation. And guess what? Most credit spreads, most credit spreads do not have a positive mathematical expectation. So you have to understand that when the industry is so infatuated with credit spreads, it's not because they provide a positive mathematical expectancy. It's because they are also combining it with some sort of market timing aspect, right? You have to have some sort of market timing aspect. So in this case, just to go through the quick math that is used to figure out the expectancy on this, you multiply the profit potential by the probability of profit, and then you subtract that by the loss potential multiplied by the probability of loss. And what you come up with is negative $1. And what that means is that for every trade that you take like this, you're going to average a dollar loss. That is a negative mathematical expectation. Then you can throw in the commissions, and that kind of all just adds up. But there is no positive mathematical expectancy with this. And so, in other words, if you were to take this trade 100 times, this exact trade 100 times, at the end of 100 trades, you would lose $100 plus whatever commissions that it cost you, right? So negative mathematical expectancy. That's the first problem that you have with credit spreads, and it's a big one, right? But what if I were to show you a way, just one simple change in that spread that creates a profit probability of 87%? And you'll also notice that the return on the risk, that's at 1.24. That is a positive expectancy. Going back to the credit spread, it was at 0.20 according to IB. So according to IB, it's at 1.24. Now this change makes it a little bit more difficult with regard to the math that is used to create the positive expectancy or determine whether there is a positive mathematical expectation. So we're going to let the picture show you, and I think you'll see exactly what I'm talking about. All right. So what is that one simple change? It's trading a diagonal spread instead. Instead of trading a credit spread, you trade a diagonal spread. So this is what it would look like, and this is the only thing I'm going to change, and it is the expiration date of the long. So I'm going to still sell one SPY April 6th, 269 call at 74 cents, but I'm going to, instead of buying an April 6th 270 call, I'm going to buy an April 9th 270 call, and I'm going to pay 70 cents for that, and that's going to create a credit of 4 cents. And I'll talk about that, about the credit here in a second. But with regard to the diagonal spread, it's a little bit different. The risk is the same. It's the strike distance minus the credit. And again, the strike distance is 1 point and the credit is 4 cents. So the maximum risk on this trade is $96 or 96 cents as opposed to 80. So it does have a little bit more risk. And then the profit is also different, but the profit is not the credit. The profit potential is not the credit. It is actually much bigger than the credit. And so the profit potential is the P&L of the short plus or minus the P&L of the long. And so you have to take into account what both are trading at in order to determine the overall P&L. And I'll show you that here again on the graph. But with this one, it has an 87% probability of profit. The question is, what is the profit potential? Right? That's really going to be the key here. And this is the projection graph of this exact same trade. And you'll notice that the profit potential for a large portion of this trade is actually much bigger than what it was on the credit spread. Now, this does create a credit of 4 cents, which means that the market can go to zero and you will make 4 cents on this trade, but that's all you're going to make on this trade. So the credit is not very big, but you are still guaranteed to at least make that 4 cents if the market craters. However, it gets interesting as the market moves up, because as the market moves up, it goes into a bigger profit zone. And the projection, if the volatility holds up, according to this trade, is that the profit potential at 269, and that's always going to be the profit peak, at 269, the profit potential is well over $100. And then it has a large range where the profit potential is over $50. And of course, an even larger range where the profit potential is over $20, which is what the profit potential on the credit spread was, right? So here is the comparison of the credit spread with the diagonal spread, the same credit spread with the same diagonal spread. And you can see here, it's a no-brainer that the diagonal spread provides a better opportunity. For the first place, the break even here, as represented by the green line, is way higher than the credit spread break-even line. The credit spread break-even line is at 69.20, 69.20, whereas the projected break-even for the diagonal spread is at about 271.50, right? So it's well over 2 points above the break-even projection for the credit spread. At the same time, if you're in the credit spread, by the time you get to the break even for the diagonal, which is way up here, if you're traded the credit spread, you are going to lose the maximum loss, which is $80. But because of the diagonal aspect, because of the long expires after the short, so there's still time value in the long when the short expires, that loss does not occur as suddenly as it would with a credit spread. And you can see it's much more gradual. And in fact, you do not see the same size loss until you see almost 275. So the market has to go from 263 to 275, according to this projection, in order to risk this or lose the same amount as you would in the credit spread 5 points sooner. Right? So this is a no-brainer. And of course, the picture is worth 1,000 years. It's a no-brainer. And diagonal spreads, as a general rule, are almost always better than their corresponding credit spreads. But there are some things that you have to keep in mind when you're creating a diagonal spread and you're comparing it to a credit spread. And the first thing is, in order to maintain a high winning percentage, you must create a credit with the diagonal spread. You can create a diagonal spread that is at a debit. And if you do that, then you aren't guaranteed to make money if the market craters. In fact, your loss will be whatever it is, the debit, whatever the debit is. So here is a similar credit spread that is creating just a small debit as opposed to a credit. And so the winning percentage on this is actually at about 35%. That's a little bit misleading because the debit on this trade is only 8 cents. And what that means is that if the market craters, you will lose 8 cents or $8 on this trade. But that's all you can lose on the trade is the debit if the market craters. Now, because this is a call diagonal spread, the real risk is if the market moves higher, as you've already seen. And so when you create a debit, instead of having the profit range from the upper break-even level all the way to zero, you have a smaller profit range, albeit it's a small risk if the market moves down. It is nonetheless risk. And so you have to remember that and keep that in mind. And at the time that you place the trade on, the market does have to move up. In this particular example, the market does have to move up in order for it to move into the profit zone. So you're at a less than 50% chance of making money on this trade, just simply because it has to make a move into the profit zone for you to get that. So what you want to do to just eliminate that is make sure that you create credits when you create the diagonal spread. That's not to say that there are not very good approaches to diagonal spreads that create debits. There are, and I do it all the time, but that is not for this blog. A little bit more complicated. Nonetheless, there is also one other thing that you have to be aware of when you're dealing with diagonal spreads, and that is that the profit range is not, and the max profit is not necessarily set in stone. And the reason for that is because when the short option expires, there's still going to be time value left in the long option, and so there's going to be a price value of that long option. And so whatever the volatility is, that's going to play a role in determining how much that long option is worth. And the greater the long option is worth, the better it is. The lower the long option is worth at the time you exit this trade, the worse off it is. All right. So if volatility drops significantly by more than 25%, according to this black line, so what I did is I stress test it. And if volatility drops by 25%, then the profit projection is a little bit different. And you still have a profit of almost $100, and you still have a break-even level that is above where the credit spread break-even level was, but it's a little bit closer, right? And that's represented by this shaded box here. The black line, you can see the break-even point is at about 270 and a half. And remember, with the credit spread, it's at 269.20. So it's still better off, but you're just dealing with a little bit lower expectations based on a drop in volatility if that in fact occurs. And so you do have to remember that. Now, the volatility has nothing to do with the risk to the downside. You will make $4 no matter what happens to volatility, because the worst thing that can happen to the long side of the option is it goes to zero, right? And so if both of them go to zero, you're going to make $4. All right, so this is the example of the credit spread in comparing with the diagonal spread, one where the volatility projection is correct, and two where the volatility projection is wrong by more than 25%, which is represented by the black line. So you can see that mathematically you're still dealing with a better trade on the diagonal spread than you are with the credit spread. And the probability of success on this one, if the volatility drops, is about 84%, as opposed to 87%, and between 83 and 84%. Still very, very high probability. Now, having said that, I want to discuss or quickly show you the secret to unbelievable winning percentages. Okay, the secret to unbelievable winning percentages that exists when you place on the diagonal spread as opposed to the credit spread. And so what is the secret to unbelievable winning percentage? And I'm telling you, you're not going to hear this anywhere else. No one else will show you this. All right, so this is truly a secret, and it's one that I have used in the past many, many times. And that secret is you can take a $20 to $25 profit on these types of credit spreads as the market moves into the profit range before the trade ends. You can't do that with a credit spread. So what happens is, in this particular example, just to kind of show it to you, as the market is moving toward the risk zone, it has to pass through the profit zone. And so here is the trade that shows the profit projection with 2 days prior to the short option expiration. And so you don't have to necessarily wait for the option expiration. Now, the profit potential is much smaller at that point because the majority of the time value drops as you get closer to expiration, right? But if the market begins to move up, you can take your profit before it ever gets to the risk zone. You can create a very, very, very high probability approach to simple diagonal spreads simply by determining that you will take the profit as the market moves up into the profit zone and before it ever gets to the risk zone. Now, it can just bypass this if the day you put it on, if the moment you put it on, all of a sudden SPY screams up 5 points, it will go through the profit zone and there will have been no time that passes. So you still have to have some time that passes in order for you to capture a profit. If it happens almost instantaneously or within a very, very short period of time, and you go all the way through the profit zone, then there is the potential that you're not going to be able to take a profit, right? So there is still risk here every now and again, but it's very, very small because the market just doesn't make these types of moves in a very short period of time. So all you have to have is a little bit of time pass by, and all of a sudden you will start to see the potential to take profits as the market moves into the profit zone and before it ever makes it to the risk zone. Now compare that to the credit, or to the credit spread. This is 2 days before the trade ends, and the credit spread has a much, much smaller window where you can take a profit on that particular trade. And once it goes up about past 266 and a half, if there's only 2 days left, you're going to start to lose on that trade, or unless it expires below the break even, which is 269.20. So you have to wait basically till the end of the trade in order to take a profit of any kind of significant proportion to what is possible with that. All right, so I just wanted to show you that and give you the reasons why in so many cases a diagonal spread is far superior to a credit spread. And so now you know that if there's a good opportunity with the credit spread, there's probably an even better opportunity with the diagonal spread. I hope you've enjoyed this blog. Again, all projection graphs are provided by paydaystocks.com, PDS Trader at paydaystocks.com.